it sounds like you're saying that the stock market is really not increasing in value as much as it would seem. It's simply generated by smoke and mirrors of stock buybacks that are increasing the numbers in the stock market, right?
Yes, yes. And company stocks are going up mostly because of the leverage of shrinking the number of shares rather than the growth in the economy, which again, 2% average since 2009, this whole recovery, the slowest recovery by far. And all, even the Great Depression, we came screaming out of that stock crash from 1933 forward. So this is a fake economy and particularly an artificially overvalued stock market, which means, and here's the important thing, stocks which have only been bought, this fourth line, by the red line is companies buying their own stocks. Everybody else is basically neutral. So investors aren't even net buying stocks. And what it creates is a big financial bubble in stocks that most crash, which you'll see in the fifth chart here. People in Wall Street keep saying, well, this isn't a bubble because of this or that and that. Look at this bubble. We've had four bubbles, two minor. The big one with tech in 2000, which everybody agreed was a bubble. Now look at this bubble. This bubble makes all of them look like nothing. This is the greatest bubble in history. It's global. The real point here, and I want to focus on this chart. This is
Harry, we got to explain some of these charts to the people that aren't seeing them, that are listening audio
okay.
only.
Where do you want to go back
let's
to?
just go back to that one, okay?
Because it's a train of thought. If you don't see, I explain one and I don't look at it, you don't get the train of thought, how we get to these high valuations of bubbles. So which one do you want to go back
Okay,
to?
well, I have a question. Is the entire, I mean, look, you say the economy is fake, and you're not wrong about that, but hasn't it always been kind of fake? And like most countries around the world are these fake propped up economies through, funny fiscal and monetary policy. I mean, that's not exactly unique to the last 10 years, is it?
Right. No, it's not. I mean, I'll
Right.
give you a quick
I,
example.
I mean, I mean, I always like to ask, compared to what, right?
Okay. Well,
Yes, it's true that the economy is built on a smoke and mirrors, but it's been that way for a long time,
okay,
and
this
so
is
is every
very
other
important,
economy.
Jay.
Yeah,
Let me
go ahead.
make this
Yeah.
crystal clear.
Okay.
Governments always stimulate the economy,
Right.
always try to
Right.
prevent recessions, lower interest rates. They always push things. They've never done quantitative easing on this magnitude. This is a cannon, a
Right.
bazooka compared to a pistol.
Okay.
Okay.
Got it. Got it.
So the Federal Reserve was created. We didn't have a Federal Reserve before 1913.
Hmm.
And guess what happened? They kept lowering interest rates every time there was the least slowdown and kept the economy from rebalancing and shaking out bad companies and bad loans, which keeps you more in balance. And we just got a bigger and bigger bubble into 1929. And then 20 years after the Fed was created in 1933, we were at the bottom of the worst depression in all of U.S. history, 25% unemployment. Blue chip stocks like Ford and General Motors and RCA back then, it's like Microsoft and Apple and Google today, down 89%. They created a bubble because of constantly stimulating, and then it crashed. But the difference is the stock market still generally went with that spending wave I had. It gets higher than it should be, and then it crashed with the economy. What we have this time, an economy that should have kept going down with slower spending, but all this stimulus made the rich people. Now, here's another important statistic, very simple. The top 20% of households, the most affluent in this country, college educated professional workers, own 88% of the financial assets outside of people's own home. 88%.
Wow, that's amazing.
They've been made rich by this bubble. They're spending more than ever. Everyday households that did not benefit, who own very little stocks, and they own smaller homes that didn't bubble as much because they're in everyday places, and that's why they're much better value now. So they're not experiencing it, so they're spending very slowly, And in the high end, now that 20%, you say, but it's only 20%. They control 50% of the consumer's spending. So 20% controls 50%. So here's how I would describe our 2% growth economy. Zero for everyday people, 4% for the affluent, and we average 2%. In a normal boom, both would be spending, and we'd be averaging 4%.
Okay, so the moral of that is the rich are getting richer,
Yes.
the middle class is disappearing, or at least the lower part of the middle class.
Yes.
Some of the middle class is moving up and moving into the upper middle class, but the lower middle class is declining sadly, and the poor are
Yes.
still poor. Yeah.